come to order, and we are very, very pleased that we have got this great panel ahead of us here. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is called a review of fixed income market structure. And as I had said to the witnesses, there is floor activity that's happening right now, so you may see a few members ducking in and out as they're having to go down to the floor, address some issues there, or to another meeting. And we'll just have to see how we are playing out here with our timing for votes and those kinds of things. But deeply appreciate your time here, gentlemen. And at this point, I will now recognize myself for 3 minutes to give an opening statement. The United States has the deepest, strongest, most liquid capital markets in the world, and the fixed income market is one of the largest sources of capital for issuers and investment opportunities for a broad array of savers and investors. While lesser known to some investors, the fixed income market is nearly twice as large as the equity markets, and it differs significantly. Fixed income serves as a vital source of funding for companies and provides a capital for them to grow and create jobs, as well as funding for local infrastructure projects such as roads and bridges. Additionally, the fixed income markets help provide opportunities for savers and investors ranging from first-time home buyers to seniors seeking opportunities for a more stable stream of income. According to the Securities and Industries Financial Markets Association, total outstanding fixed income debt is nearly 40 trillion with a T, with new issuances between 6 and 7 trillion per year over the last 5 years. On average, $775 billion of securities are traded each and every day. Today's hearing will focus on the current market structure and potential ways to improve the transparency, liquidity, efficiency, and other aspects of fixed income markets. Since fixed income markets are different than equity markets, they should have a regulatory structure that appropriately reflects the market's unique characteristics. We will both review the current domestic and international regulatory regime for fixed income markets, liquidity, data transparency for fixed income asset classes, and the increased deployment of technology and electronic trading platforms in fixed income products. Our witnesses will also review components that are working well in the fixed income market, components that need improvement, and components that may negatively impact the market's optimal functionality. The objective of this hearing is to provide this subcommittee with the background and foundation to examine the optimal design of the fixed income market based on today's market conditions. In a July 12 speech, I was pleased to hear Securities and Exchange Commission Chairman Jay Clayton say, quote, "The time is right for the SEC to broaden its review of market structure to include specifically the efficiency, transparency, and effectiveness of our fixed income markets. As waves of baby boomers retire every month and need investment options, fixed income products, which are viewed as a stable place to store hard-earned money, will attract more and more Main Street investors. The Commission must explore whether these markets are efficient and resilient as they expect them to be, scrutinize our regulatory approach, and identify opportunities for improvement. To that end, I have asked the staff to develop a plan for creating a fixed income market structure advisory committee, like the MSAC, that this committee would be made up of a diverse group of outside experts who will be asked to give advice to the Commission on the regulatory issues impacting fixed income markets," end quote. I can just say this, bravo. This is an area where we can put partisan politics aside, and I believe that the SEC and Congress can work together to make sure that the fixed income market is performing optimally for all investors and the economy. I look forward to hearing from our witnesses today. At this, the chair now recognizes the ranking member of the subcommittee, the gentlelady from New York, Ms. Maloney, for 5 minutes for an opening statement.
I thank the gentleman for calling this important oversight committee, and we have an outstanding group of panelists today. This hearing will address the market structure of the corporate bond market, the Treasury market, and the municipal bond market. The bond markets are both incredibly important to our economy. The corporate bond market allows companies of all sizes to raise capital to expand their businesses, hire more employees, or invest in new equipment. And the Treasury and municipal bond markets allow governments to finance their day-to-day activities at a very low cost to taxpayers. U.S. companies raised over $1.5 trillion in the bond markets in 2016, the 5th consecutive year of record issuance, and the federal government raised about $2.2 trillion in the Treasury market in 2016. With so much money at stake, it's important to ensure that the secondary market for these bonds is robust and efficient. A couple of weeks ago, this subcommittee examined the market structure of the U.S. stock market, so it's only logical that we also examine the structure of the bond markets as well. And what we find is that the market structure of these markets, the stock market and the bond markets, are as different as night and day. The stock market is a highly electronic, mostly exchange-traded market made up of mom-and-pop retail investors, institutional investors like mutual funds and pension funds, banks and brokers, and high-frequency trading firms. Trades in the stock market happen so fast that they're measured in microseconds, which is 1/1,000,000th of a second. This is largely because stocks are highly standardized. One share of Apple is interchangeable with another share of Apple, and there's so many shares outstanding. In contrast, the corporate bonds are not standardized at all. A big U.S. company like GE has around 900 different bonds outstanding, each with different terms, maturity dates, so trading is much more fragmented in corporate bonds. As a result, corporate bonds don't trade on centralized exchanges like stocks. Instead, they trade through banks acting as dealers. Dealers hold large inventories of bonds so that when an investor like a mutual bond wants to buy a particular corporate bond, the dealer can sell them and that bond out of its own inventory. So in corporate bonds, it is the dealers who are responsible for maintaining an orderly liquid market. The structure of the Treasury market is somewhere in between the stock market and the corporate bond market. Treasuries are much more standardized than corporate bonds. All Treasury bonds are issued by the same issuer, the Treasury Department, and the terms are not customized. The Treasury Department mostly issues the same 2-year, 5-year, 10-year, 30-year bonds over and over again. Because of this standardization, the Treasury market has become significantly more electronic and significantly faster in the past decade. It is still a dealer-based market like the corporate bond market, but those dealers now include a lot of high-frequency trading firms, and when dealers trade with each other, it is done almost entirely electronically now. But when dealers trade with their customers, the mutual funds and pension funds that buy and hold Treasury securities, they still trade over the phone like in corporate bonds. This trend toward more electronic, high-speed trading in Treasuries has likely made the Treasury market more efficient, but also more fragile, which is worrying. But I want to make 2 points before we hear from our witnesses. First, for all its flaws, the Treasury market is still the largest, deepest, and most liquid bond market in the world. This allows the federal government to borrow at extremely low interest rates, which ultimately saves money for taxpayers. So we need to be very careful before we make changes to the Treasury market, because if we get it wrong, then taxpayers will end up footing the bill. Second, the corporate bond market has never been, and likely never will be, a very liquid market. So while it's important to monitor the health of this market, we shouldn't fool ourselves into believing that corporate bonds will ever be anywhere near as liquid as stocks or even Treasury bonds. With that, Mr. Chairman, I look forward to hearing from our witnesses, and I thank you for holding so many substantive and important oversight hearings.
Gentlelady yields back, and my pleasure. With that, the chair would like to recognize the vice chairman of the committee, the gentleman from Illinois, Mr. Hultgren, for 2 minutes.
I would also like to thank Chairman Huizenga for holding so many important hearings. It's been a busy couple of days, but really important for us to tackle the challenges facing our markets, especially reassessing some of the policy responses made by Washington during the financial crisis. We've spent a lot of time debating the modernization of our equity markets, but our fixed income markets should not get overlooked. And while we can draw lessons from the modernization of our equity market structure, we must also be cognizant of the inherent differences between these financial products and markets. I was very encouraged to see Chairman Clayton state in his speech before the Economic Club of New York earlier this week that he'd like the Securities and Exchange Commission to be more focused on fostering the development of our fixed income markets and ensuring investors have access to products with reliable returns. I also applaud his proposal to create a fixed income market structure advisory committee similar to the equity market structure advisory committee formed by his predecessor. For this to be an effective committee, it will of course need to include the right perspective of market participants, such as small and middle market dealers. It will also need a strong mechanism for making recommendations to the commission so that its work won't go overlooked. Finally, I'd be remiss not to mention that in addition to serving as vice chair of this subcommittee, I serve as co-chair of the Municipal Finance Caucus in Congress. Our work is generally focused on preserving the tax-exempt status of municipal bonds, which I believe is foundational for states and local governments, especially smaller issuers, for accessing the capital markets. Through this work, I have had the opportunity to hear the perspective of dozens of market participants, and I look forward to weighing this against the recommendations that will be made before this committee today. Thank you again to all of our witnesses, excuse me, and I yield back.
Gentleman yields back. Today we have a great panel in front of us. The challenge with us doing this on a fly-out day is when everybody is trying to escape Oz. We are trying to get back home, but that means votes are getting moved around a little bit. We've just gotten a notice that votes will be approximately somewhere between 10:25 and 10:40. We're going to be on the floor for about an hour and 15 minutes, and so if any of the witnesses would care to shorten up their opening statement, that would be appreciated so that we could get to questions. I will note that all of your testimony is submitted for the record as well, and you will each be recognized for 5 minutes, but if you have the ability to shorten it up, that would be appreciated. First and foremost, we have Mr. Matt Andreessen, who is the founder and CEO of Headlands Global Markets and the CEO of Headlands Technologies, LLC. Mr. John Shea, who is the Senior Vice President and Global Head of Fixed Income and Commodities at NASDAQ. Mr. Alexander Sedgwick, Vice President, Head of Fixed Income Market Structure and Electronic Trading with T. Rowe Price on behalf of the Investment Company Institute. Mr. Jonah Crane, former Deputy Assistant Secretary for the Financial Stability Oversight Council, FSOC, in the U.S. Treasury Department. And Mr. Randy Snook, Executive Vice President, Securities Industry and Financial Markets Association. Gentlemen, we appreciate you being here. And with that, Mr. Andreessen, you are recognized now.
Thank you. Thank you, Chairman Huizenga, Ranking Member Maloney, and members of the subcommittee. I am Matt Andreessen, the CEO of Headlands Global Markets. We welcome this opportunity to present our views on fixed income market structure and in particular, the secondary market for municipal bonds. HGM is an SEC-registered FINRA member broker-dealer. It launched its municipal bond trading in 2014 and uses proprietary models to trade bonds electronically. HGM is a widely recognized muni participant, executing close to 1,000 trades a day with over 400 counterparties, ranking as a top participant on all major muni platforms. In addition to HGM, I also CEO of its affiliate, Headlands Technologies, one of the largest global trading firms in more liquid securities. Before founding HGM, I was co-CEO of Citadel Securities, and prior to that, I was CEO of Island, the largest electronic stock market in the U.S. At that time. And currently, I serve on the SEC's aforementioned Equity Market Structure Advisory Committee. Last year, $458 billion in municipal bonds were issued by local governments. Most carry tax advantages, making them an attractive vehicle for retail investors. In fact, retail holds an estimated 75% of municipal bonds. Retail investors also trade in the secondary market. Last year, 47% of secondary market trades were for 25 bonds or less, indicating active retail participation. The secondary market is a dealer market. Investors interested in buying or selling a bond need to contact a dealer for pricing information. Public post-trade pricing data is of limited use to investors if the bond of interest has not traded recently, which is usually the case. And due to the abundance and diversity of municipal bonds, there's approximately 1 million unique municipal bonds today, compared to only 3,800 listed equities. Investors often struggle to identify comparable bonds, making investors dependent on dealers for pricing information. The market has seen several recent areas of improvement, however, such as the increased use of bid-wanted auctions, implementation of best execution rules, and the forthcoming markup markdown disclosure requirements. Notwithstanding these positive developments, there are still areas in need of improvement. We share the committee's excitement about SEC Chairman Clayton's call this week for a broad review of fixed income. We're going to highlight 3 areas ripe for improvement. First, there's the problematic practice of filtering. Filtering occurs when a broker-dealer handling its own retail customer's order requests a quote and starts an ATS auction, but filters out responses from specified dealers. Filters are used in ways that restrict market participation, resulting in investors not receiving the best available price. Second, there is the anti-competitive practice of a trade-through, which occurs when a retail broker-dealer initiates an auction for a customer, but then ignores the results, purchasing the bonds from its customer for its own account at a lower price than the winning bid in the auction. This practice is harmful because it results in bonds sold at inferior prices than those that were available at the time of execution. Lastly, there is last look, where the submitting broker-dealer observes the prices in their completed auction and then purchases the bond from the customer at a price equal or slightly better than the winning bid, even though MSRB Rule G43 appears to prohibit such practice. This practice harms competitiveness by deterring aggressive pricing by other dealers who know the submitting dealer may step in front of their winning price. We are hopeful that the competitiveness and transparency of these markets will continue to improve as more attention is paid to these problematic areas, and as recently enacted rules such as best execution and markup markdown disclosure are implemented and appropriately enforced. We appreciate the subcommittee's attention to these important issues. Thank you.
Thank you very much. With that, Mr. Shea, you are recognized.
Thank you, Chairman Huizenga and Ranking Member Maloney and other members of the committee today for the opportunity to testify today on fixed income market structure. The market for U.S. Treasury securities is widely recognized to be the most liquid and consequential market in the U.S., and the U.S. Treasury bond reflects the stability of the United States and our nation's strength. However, the market could benefit from greater transparency, organization, and efficiency. NASDAQ applauds SEC Chairman Clayton's call this week to form a Market Structure Advisory Committee to help the SEC study and understand the evolution of these important markets. NASDAQ has extensive experience operating markets, and with NASDAQ Fixed Income, our lineage as the first electronic trading platform, we operate one of the largest and most liquid fixed income cash markets in the world. Currently, our client profile features 112 institutional clients, including 23 primary dealers. We offer trading through our SEC-registered ATS and FINRA-regulated broker-dealer entity, utilizing an anonymous, fully electronic central limit order book using price-time priority. NASDAQ's analysis of market structure reforms is driven by the application of core principles derived from this experience. NASDAQ believes that the market for U.S. Treasuries can be significantly improved on each of the following measures. 1, transparency benefits all market participants. 2, regulation must be clear, consistent, and technologically driven. 3, competition on a level playing field. 4, equal access to trading promotes efficiency. And 5, all investors are entitled to a fair deal. These markets are evolving and they are becoming more fragmented and segregated and subject to uneven and uncertain regulation and enforcement. Therefore, NASDAQ recommends the following basic improvements to better serve market participants and to protect investors. Transparency. Trace reporting to FINRA was a positive step just begun this past Monday. The further evolution towards a comprehensive centralized reporting mechanism is absolutely critical. NASDAQ does not support radical change in this area. We prefer a cautious and incremental track towards regulatory reform. On 15 October 2014, the current market structure, as we know it today, experienced an unusually high level of volatility and significant price movements. It is important to state that such events are not common in the U.S. Treasury markets. As an operator of one of the primary U.S. Treasury venues, NASDAQ could not evaluate the liquidity and/or efficacy of the entire market either in real time or on a delayed basis then or today. October 15th prompted 5 federal agencies to review the day's events along with trading data. The resulting findings report published 13 July 2015 noted that while banks and non-banks continued to execute transactions, it was the non-bank firms represented more than half of the traded volume that day. Recommendation number 2 is to impose minimum regulatory requirements on all venues to ensure fair and orderly markets. Well-functioning markets must be transparent, fair, and orderly. This requires uniform minimum regulatory standards across all trading venues. For example, rules similar to regulation SCI would ensure that participants in the U.S. Treasury markets develop systems with sufficient capacity, resiliency, availability, and security to minimize the occurrence of disruptive systems issues. It is critical that trading venues do their part to keep bad actors out of the Treasury market. NFI is operated by a FINRA-regulated broker-dealer and an SEC-registered ATS, and upholds its duties through a vetting process that includes robust Know Your Customer and anti-money laundering monitoring standards under the U.S. Patriot Act. NFI uses a third-party vendor to investigate each customer by comparing their information against 120-plus government-managed lists and websites for any negative information. NFI does not allow any access to the ATS prior to confirmation or clearance. NFI engages the same vendor to conduct continuous monitoring of customers and receives alerts when negative news is obtained. In summary, we strongly advocate for the standardization of regulatory standards and surveillance practices across all U.S. Treasury venues. Each U.S. Treasury venue should perform similar market monitoring surveillance for the activity related to that venue. Recommendation number 3 is to reduce systemic risk by requiring cost-effective clearing of all transactions, be it centralized or through an interoperable model. The clearing market structure, in our view, has fallen behind the realities of automated trading. The lack of centralized clearing solution poses material counterparty risk to the market and leads to the following: less transparency as to the size of exposure, concentration risks, clients having to post collateral at multiple venues, and a decentralized default management process that is cumbersome and prone to delays and errors. We appreciate the opportunity to testify on these important issues. I'm happy to answer your questions.
Thank you very much, Mr. Sedgwick.
Thank you, Chairman Huizenga, Ranking Member Maloney, and members of the subcommittee for inviting me to testify today. My name is Alexander Sedgwick, and I'm the head of fixed income market structure and electronic trading at T. Rowe Price, a global investment management firm with about $860 billion in assets under management. I'm also appearing at this hearing as a member of the Investment Company Institute, a leading global organization of regulated funds. We greatly appreciate the subcommittee's continuing interest in ensuring the quality and integrity of the fixed income markets. These markets provide a critical source of capital for companies and governments, facilitating job creation in corporate America, financing municipal infrastructure projects, and providing a vital funding mechanism for the federal government. The funds offered by T. Rowe Price and other ICI members play a significant role in this capital formation process by investing on behalf of millions of retail investors saving for their long-term financial goals, such as purchasing a home, paying for college, or funding their retirement. Enhancing the transparency, liquidity, and overall functioning of these markets is particularly important because fixed income market dynamics affect our ability to deliver on investment mandates, and so we applaud the subcommittee for holding this hearing. In my written statement, I outline the evolution of the U.S. government bond market, not because I think members of this subcommittee need that history lesson, but because it illustrates how fixed income market structure evolves, and it speaks to 2 important points. Fixed income securities can, and indeed historically have, traded in a variety of ways. Further, the development of fixed income market structure has not been linear, but it has been influenced by the changing needs of market participants, including issuers, buyers and sellers, and liquidity providers. The result is that the fixed income market is a collection of diverse sectors, each with its own unique structure, the largest and most liquid of which is the U.S. Treasury market. One thing I'd like to note is that many of the studies focused on the Treasury market have been constrained by a lack of market data. A 2015 study done by the staff at the New York Fed concluded liquidity is in line with historical standards. While we generally agree with this conclusion, along with the joint staff report of 2014 on the flash event, both of these reports relied on data provided by interdealer trading platforms, which highlights the need for a more comprehensive source of information in this market. As a result, both T. Rowe Price and ICI are supportive of the regulatory reporting of Treasury trades, which began earlier this week. Before discussing the corporate bond market, I'd like to consider transparency more broadly. Buy-side firms have a range of strong views on transparency and public dissemination of trade data. T. Rowe Price has been and continues to be broadly supportive of greater transparency in fixed income markets, although we recognize risks in this regard. We encourage regulators to thoughtfully consider requirements to foster transparency and implement those requirements in phases with regular periods of review to minimize any unintended consequences for market participants as well as any market dislocations. This kind of careful approach can produce a transparency regime that appropriately balances the benefits and risks of additional transparency. Turning now to the credit markets, there has been no shortage of commentary regarding the current state of liquidity. At T. Rowe Price, we have an optimistic long-term view. We believe that a modest increase in both yields and volatility may result in several constructive developments, including increased interest from long-term investors, similar to what we saw during the 2013 taper tantrum, buyers and sellers developing differing views of value, which is critical to creating two-way and more vibrant markets, widening bid-offer spreads, which would entice market makers to allocate capital to liquidity provision. We are also excited about the continued development of greater electronification. While less ubiquitous than in other markets, e-trading continues to grow steadily in corporate credit markets. T. Rowe Price believes that removing obstacles to further electronification will improve price discovery and facilitate best execution. Moreover, given the recent proliferation of e-trading platforms, regulators may consider standardized reporting for trading volumes, which would help market participants evaluate which platform meets their trading needs. As I said at the outset, the fixed income markets play an important role in helping millions of Americans save and invest, and enhancing the structure of these markets is critical to their success. We greatly appreciate the subcommittee's time and their continuing interest in these issues. Thank you.
Thank you very much. Mr. Crane, you're recognized for 5 minutes.
Thank you, Chair Huizenga. Thank you, Ranking Member Maloney. Thanks to the members of the committee for inviting me to participate in today's hearing. I was sitting in the Treasury Department on October 15th, 2014, when somewhere around 9:30 in the morning, all of our phones started to blow up with several alerts. And we looked down and saw price alerts about the Treasury market. And after shouting several expletives, we gathered around a Bloomberg terminal and tried to figure out what was going on. And the reality is, we couldn't figure out what was going on. We couldn't figure out what was going on that morning, and it took 5 agencies several months to figure out what had happened that day. So following October 15th, an interagency group of 5 agencies got together and conducted what was the most comprehensive review of Treasury market structure in about 20 years and made several recommendations. Those recommendations will be reflected in my written testimony, and I'll get to them very shortly. Broadly speaking, I think what you're hearing consistently across the panel is that fixed income markets are undergoing a period of transition. It's not necessarily a recent transition, it's not necessarily limited to fixed income, and it's certainly not proceeding all at one speed. Nonetheless, there is clearly a big transition underway. The big theme is electronification of financial markets. It's occurred in other markets, beginning with equities and futures in the 90s, moving into foreign exchange, and at this point it's moving into really all areas even of fixed income markets. I would just echo the chair and the ranking member who noted that it's important to think about the unique characteristics of the underlying market when thinking about the ways that a policy framework should shape the evolution of this trend in the different markets. With respect even just to the Treasury market itself remains pretty bifurcated between really a dealer market on the one hand and a client market on the other hand. When end users like mutual funds and insurance companies want to trade treasuries, they still generally do so exclusively through dealers in bilateral transactions. And the interdealer market, which has opened up in the past decade to non-bank dealers like principal trading firms, you've really seen a full evolution into markets with predominant high-frequency trading now accounting for a majority of trading in the interdealer market. So the evolution of electronification, even within Treasury markets, is really running at 2 speeds. And I think the recommendations that the Interagency Working Group made and that I will echo today really will achieve a couple things. One, they will bring new competition into the Treasury market or facilitate the continued entry of new competitors into the Treasury market. And you could see a broader, more diverse spectrum of liquidity provision across the Treasury market, which I think would create a healthy ecosystem over time. 2, it will improve resilience in the market. I think some of the recommendations that you heard Mr. Shea discuss and some of the recommendations that the Interagency Working Group discussed would bring important stability and confidence to the market. The recommendations specifically here were registration of market participants, registration and minimum standards for trading venues, and I think those are important improvements that will help to modernize the oversight of the Treasury market. I'll end there and leave the rest of my testimony to be submitted for the record and look forward to answering your questions. Thank you.
Thank you very much. Mr. Snook, you're recognized for 5 minutes.
Chairman Huizenga, Ranking Member Maloney, and distinguished members of the subcommittee, thank you for providing me the opportunity to testify today on behalf of SIFMA and to share our views on the structure and the health of the U.S. fixed income securities markets. The U.S. fixed income markets are truly without parallel, with nearly $40 trillion in debt outstanding, and on average, over $775 billion of securities are traded each and every day. As the trade association representing a broad range of financial services firms active in all aspects of the fixed income markets, SIFMA is dedicated to promoting investor opportunity, access to capital, and an efficient market system that stimulates economic growth and job creation. Traditional bank lending is often pointed to by policymakers as the driver of economic growth, but we're here to highlight the more significant source of financing that drives our economy, the capital markets. Bonds finance everything from home mortgages and car loans to highways and schools to factory and equipment, as well as the federal government itself. The bond market sets the interest rates for commercial and consumer lending and provides a safe and predictable investment for millions of Americans. Now, the cumulative impact of post-crisis reforms must be studied and reconsidered to ensure our capital markets are providing funding in the most efficient way possible. This is particularly important since private credit extended to households and non-financial businesses has grown at a slower pace than in all recoveries in the past 60 years. SIFMA supports many of the post-crisis capital reform efforts and believes they have enhanced the overall resiliency of our capital markets and system. However, now is the time to review how those rules work together, with a particular emphasis on determining where they may be impeding liquidity by targeting the same risk in multiple ways. A review should also include the new liquidity and leverage requirements, but also look at the effect of the interactions with the CCAR rules, Basel III capital rules, and single counterparty credit limits. We firmly believe that this sort of clear review of the potential costs of the current and additional requirements, which could limit the capital available for lending, should be undertaken, and we're pleased to see that policymakers have begun to move in that direction. While trying to understand the state of liquidity, it's certainly helpful to understand the end users and investor points of view. In a 2014 and 2015 survey of corporate bond investors, Greenwich Associates asked about the ease of trading corporate bonds by size. In each year of the survey, 75% of the investors found it difficult or extremely difficult to execute or trade in block sizes of corporate bonds measured as 15 million and larger in size. Regulation does indeed impact liquidity. For example, the Volcker rule limits on trading by banks, in some cases constrain dealers' ability to take on trading positions and build inventory necessarily for market making. Capital and leverage rules also limit dealers' ability to finance positions held in inventory and can clearly limit their ability to commit to customer trades. Although just one of the markets discussed here this morning, the importance of the Treasury market to our system and to our economy cannot be overstated. This unique, resilient, and robust market serves multiple roles, including the transmission mechanism for monetary policy and as a safe haven investment, particularly during times of financial stress, and most importantly, as a source of stable and efficient funding for the federal government. Given its importance, continued study of any potential changes is required to ensure the Treasury market and the Treasury securities market remain the preeminent benchmark in the world. Any changes to regulation should be carefully calibrated to support both the resiliency of the market and the role of the Treasury market, and recognize the unique auction process that has allowed the Treasury to finance the government and government activity at extremely low cost to taxpayers. We support the government's program to collect secondary market transaction data, which began last week. Additional changes, however, including the public dissemination of that data, need further careful study, including a clear articulation of any potential benefits to the market to ensure no harm. In conclusion, SIFMA believes that policymakers have the ability to enhance economic activity through tailored recalibration of rules and regulations affecting our capital markets. This recalibration could help jumpstart the economy without sacrificing financial stability. We very much appreciate the opportunity to present our views here today. We look forward to working with policymakers to help ensure that our capital markets continue to perform their vital functions and operate safely and efficiently to move America forward. I look forward to answering your questions. Thank you.
Thank you. And thank you each for your testimony. At this time, I will recognize myself for 5 minutes. And I'm going to try to move rapidly through this and make sure we have time for other members here. Given the testimony today, I've heard a lot about transparency in fixed income markets. Mr. Shea, Mr. Sedgwick, especially, you noted in your testimony there's room for improvement in that transparency and reporting of fixed income transactions, such as FINRA's TRACE, Trade Reporting and Compliance Engine reporting regime. Can you please explain how this is helpful to both regulators and to market participants?
Sure, I'm happy to start. Without market data, and as we saw back in October of 2014, and as I think you've heard from testimony from members today, it took over a year for the regulators and the 5 different government agencies to come together with a proper understanding of what happened. And in my oral testimony today, I just mentioned as well that if there were to be another similar like flash rally or 12 minutes of fury, as we called it, it would be very difficult for us as a venue to be able to diagnose what actually happened. It would be nearly impossible for the regulators. It would have to be another multi-month process. But during the crisis, I was working at a professional trading firm named Virtu Financial, and we were in the enviable position of having market data inputs from the various futures venues, from the cash venues, from the various direct venues that we were using to trade this product, and it was very easy for us to recreate what had happened. In fact, we had spent some time with both the Federal Reserve and with Mr. Crane at Treasury reviewing our market data, but of course it had to be confirmed independently, and that took an enormous amount of time. And certainly in that period of time, Mr. Chairman, I think it would have been very helpful if the regulators, Treasury and Fed, all had that data at their fingertips to be able to diagnose the problem.
Mr. Sedgwick, do you care to jump in on that?
Thank you for the question, Chairman. So I would say there are 3 main areas where transparency is important to us. The first is, as we're trying to deliver on our investment mandates, it allows us to identify relative value opportunities within the market. So the ability to look at where individual bonds have traded and the relative value from an investment perspective. I think additionally, liquidity has been a topic that we've talked about all in our opening statements. I'm sure it's something we'll talk about further today, but it really is helping us identify where there are pockets of liquidity in this market. Of the 20,000 or so investment-grade bonds, there may only be 6,000 trade on a given day. It's important for us to understand which ones those are so we can frame up the market from that perspective. I think the final piece that I would point to in many respects is probably the most important, and that is we leverage TRACE data for trade cost analysis. That allows us to give transparency back to not only our portfolio managers internally, but also our retail and institutional clients.
So again, I'm hearing a lot about the transparency, and I know, Mr. Andreessen, you talked a little bit about filters and last look and some other things, and Mr. Shea, you had talked about, I think that point number 3 and 4 were equal access and fair trades. Some have called for an electronic trading platform for fixed income lead in order to increase this transparency. Is that the right direction to go?
I think without question it is. Americans insist on transparency in almost all of their economic transactions. If you own a house, you're able to find out if anyone else in your neighborhood sold their house, what the price was. It's a matter of public record. Imagine trying to put your house up for sale and having no price discovery, no idea what prices there may have been in the last 2 years, the last 3 years.
So is that a vital piece? I mean, getting this electronic?
I think without question, in municipal bonds we have the EMMA system, which we can see every trade that happens is reported in near real time and is visible for all investors. This is a critical tool for investors to understand where the market is pricing risk. But the challenge for municipal bonds, and no, I know I scared you. You thought this was my testimony.
Yeah, I noticed you had a little book.
This is a 5 columns printed on both sides, a list of individual municipal bonds. This is 700,000 individual securities. Most of them do not trade in a given day, a given week, or a given month. So just having that bit of pricing.
You did mention that's only A through N.
Yeah, that is A through N. My colleague is not fit enough to carry the whole.
So I mean, I think what we're going to need to find here, though, is consensus, and is there industry consensus on this, that this is a direction to go? And that's certainly something that I'm looking for in this. My time is up, but I suspect that you will have some fairly extensive written follow-up questions as well for everybody, and I look forward to that. So with that, I recognize the ranking member, Ms. Maloney, for 5 minutes.
Thank you, Mr. Chairman. Mr. Crane, you mentioned in your testimony that you were there for the very famous Treasury flash crash in 2014, and one of the recommendations coming out of the staff report was that firms should be required to report their transactions in treasuries to regulators on a daily basis. And as I understand it, it's being implemented even this Monday by the SEC and FINRA to have that take place. But one of the other debates following that action was whether treasury transactions should be reported publicly as well. And some have said that this would be unfair, high-speed traders would take advantage of it, but others have thought that it would increase market quality and stability and bring more investors in. So what are your thoughts on this? Should transactions in treasuries be reported publicly or just to regulators?
Well, thank you for the question. I don't want to, I don't think it should be underestimated how important the launch of official sector reporting on TRACE was this week. That's an important step, and I commend FINRA and the SEC for following through on that initiative. As Mr. Shea pointed out, it'll be really helpful in future episodes of volatility to try and diagnose what had happened. You asked about making that information more broadly available to the public, and I do think that that is an important next step. Public transparency can improve liquidity in markets, it can improve participation, create a more level playing field. And I think history shows that when you've brought transparency to new markets, especially when it's been done in a thoughtful way, that it can improve the overall health of the market. I do think it is important for it to be done in a thoughtful way. It's important to think through the unique characteristics of treasuries and the role that they play in the global economy. You have large reserve managers around the world and large institutional investors like insurance companies who hold large amounts of treasury securities, and if they need to trade in large blocks, putting that trade out there for the world to see may be a risky proposition. So I think it is important to think through how to accommodate the important unique aspects of treasuries, but I think that can be done with thoughtful design. When FINRA originally launched TRACE for corporate bonds and then for agency mortgage-backed securities, they took a similar thoughtful approach. They implemented delays in reporting. They implemented size thresholds so that block trades were masked, for example. So I think it's important to be thoughtful about it, but the concerns that have been raised about public transparency in treasury markets can be addressed through thoughtful design.
Okay, what are your thoughts on it, Mr. Sedgwick and Mr. Shea?
So, as I mentioned in my opening statement, T. Rowe Price has been broadly supportive of transparency across markets. Well, we're aware of some of the risks that I think Jonah outlined. I think in general, we look at the way TRACE has been administered as they expand to new asset classes and the extent to which disclosure has been adjusted accordingly. And so I think in this particular case, presuming the same approach is taken, we would find value in that. I think one thing to point out is in some respects, when you're looking at the credit markets, you're dealing with sort of investment views being articulated through a trade. In treasuries, in some respects, you're also dealing with collateral trades. You're dealing with a variety of other reasons you would trade those securities. So in some respects, that information may be less sensitive.
Yeah, Mr. Shea?
I find it always interesting when I hear public data being made available to the professional trading groups as being a negative, as we've seen those particular firms enhance other markets that we at NASDAQ are very active in, most notably the equity market, the equity option market, the listed futures market. But it does strike at the heart of real clearing. The large banks in the last 8 years have become extremely good at managing their technology as well as world-class at managing risk. They're enormously, you could almost argue, overcapitalized at this moment. And they're wonderful in that they have large balance sheets, they've got a huge list of clients, and they manage the risk for them. So the idea would be making data public to everyone in a way doesn't level the playing field. It's just a normal response. As Mr. Andreessen noted, you're not going to sell your house without market data. You're not going to buy a new car from the dealer that you always go to when you could buy it from a dealer across town for $1,000 or $2,000 less.
Thank you. And Mr. Crane, there's been a lot of talk on this committee about how the liquidity in the corporate bond market has declined in recent years. And do you think it's declined enough that major regulatory changes are necessary?
It's a good question. I think, first it's important to remember that it's declined from a pre-crisis period that is probably not the best benchmark to use. I think the pre-crisis period was an anomaly in terms of extremely high liquidity, and it was probably driven by a lot of leverage and turned out to not be all that resilient as we discovered. So I think I would hesitate to draw any firm conclusions about how far liquidity has deteriorated.
My time has expired. Thank you.
Gentlelady's time has expired, and unfortunately, they have announced that they are moving up votes. We don't know exactly when that will be, but my intent is to try to get through as many people as we can, and then we will evaluate about if our panel is available to then take that break, vote, and come back if you are able to stay. So with that, I recognize the Vice Chairman of the committee, Mr. Holmgren, for 5 minutes.
Thank you so much, Chairman. Thank you all for being here. We appreciate your testimony. Mr. Andreessen, it's great to see you. Thank you for coming out from Illinois to testify today. We've seen our equity markets evolve more quickly than our fixed income markets, at least in terms of number of trades being executed electronically. As someone who played an integral role in the development of our modern equity markets and who now serves on the SEC's Equity Market Structure Advisory Committee, what takeaways do you think we can apply from this evolution in our equity markets to our fixed income markets, if any? And do you believe our fixed income markets will continue to develop due to market forces, or what other role should government have, if any?
Well, I think government can play an important role here. Fixed income, as you see from my list of securities here, will never look like the market for Google or Amazon or Facebook. There's a very small number of equity securities. A lot of interest, as Ranking Member Maloney pointed out, are concentrated on one product. Whereas in fixed income, even if you have a multitude of issuers, all sometimes with hundreds of different securities. So you're never going to have streaming bids and offers driven by natural flow. Most times things will only trade by appointment. But that doesn't mean that electronic trading can't play an important role and that government can't play an important role facilitating this. Already today in the muni markets, there's about 40,000 trades a day, and about 8,000 of those actually take place on alternative trading systems. Now, the primary method of trading on this is not doesn't look like the New York Stock Exchange or like NASDAQ. It looks like an auction that takes about 4 hours. An auction is initiated. Participants that come in can bid on this, and it's a competitive auction that yields a very good price. In fact, today, there's an average of over 7 bidders per auction. If you had 7 bidders on your house, you'd probably get a really good price. So this is a very robust process that is working. The challenge we have, and where I think government has taken the lead, is to try to bring in new rules to encourage the use of this facility and to encourage the proper adherence with best practices for how the rules work within those auctions. Routinely, we see 15 to 20 bidders in these auctions, and I think if with the new rules coming into effect, if you had the majority of orders in these auctions, you'd have a very efficient result, but we're not there yet.
But you would say, it sounds like from your answer, you would say that these auctions are competitive for municipal bonds?
The auctions are, we were very surprised when we got in this business. It took us years to build the modeling to be able to make these prices, and we anticipated that because of our breadth, we'd sometimes go to these auctions and be virtually alone. And we were very surprised to find that they're actually quite competitive.
That's helpful. Mr. Snook, would you have any response to that? Do you agree? Do you disagree? Can you turn your mic on?
I think the main point we'd want to emphasize around electronic trading, and electronic trading has been growing and developing for close to 20 years now. Some of the entrants in the marketplace were there in the late 90s, and there have been a large number of new entrants coming into the market. So we're in favor of pro-competitive forces, encouraging the innovation and experimentation that is happening. In each of the markets, we see different degrees of adoption and use of electronic trading. I think that's a good thing, but we think it's important that it kind of can and should develop as organically as possible in a pro-competitive way without really deciding externally what the correct market structure should be. Let's let entrants come in, innovate, compete, find the best ways to use and leverage the technology and leverage the data. And I think that's what we see. You know, we see corporates at 20% traded electronically now. There are estimates that the MBS market, agency MBS, is close to 3/4. Parts of the government market, particularly in the on-the-run sector, near 100%. So we're in favor of encouraging more electronic trading, but not imposing that externally.
Let me ask one last question here to Mr. Shea. You mentioned in your testimony that NASDAQ is not advocating for something similar to Reg NMS being applied to U.S. Treasuries. What steps can policymakers take to acknowledge the imperfections of Reg NMS and to make sure any potential new rules are appropriately tailored for Treasuries? We just have a few seconds, I'm afraid.
I think it comes down to clearing. And right now, you've got a market that some securities with FIC clearing members clears at FIC, part of the DTCC, some clear at the FedWire. You've got this global risk-free rate that exists as the benchmark of the world, and yet it doesn't perfectly clear. And when you do clear it at FIC, it's very expensive, it's cumbersome, anachronistic, idiosyncratic rules that no longer make real-day modern market sense.
Thank you all. I yield back.
Gentleman's time has expired. The chair recognizes a gentleman from Connecticut, Mr. Himes, for 5 minutes.
Thank you, gentlemen, and thank you, Chairman Huizenga. I'd like to echo the ranking member's gratitude for the substantive and generally nonpartisan approach of these hearings. Very much appreciate it. Gentlemen, I want to ask you a question about the Volcker rule and its effect on liquidity. We went through a big exercise in the passage of something called the Choice Act, which was really kind of a rollback of many Dodd-Frank regulations. The premise was that the Dodd-Frank regulations were harming capital markets. And if you look at capital markets, actually, there's not much data to support that, whether it's venture capital, private equity, corporate bond issuance, secondary markets, IPOs, you name it. Those markets are pretty robust and growing. That's not necessarily true in smaller business lending. And Chairman, I'd love to see us take a look at the issues affecting smaller business lending. It also would appear that there is some data and studies supporting the notion that the Volcker rule, which I strongly support, I don't believe that FDIC-supported institutions should be making proprietary bets. There is a Federal Reserve study and other suggestion out there that in moments of stress, we may have a liquidity issue in the corporate bond market. So I guess I'm going to point this question first to Mr. Crane as a non-private sector participant, but then somebody else from the private sector. Are you concerned that the Volcker rule is in fact constraining liquidity in a way we need to be conscious of? And then if you agree with me that we probably shouldn't do away with the Volcker rule, meaning, you know, we don't want FDIC-insured institutions taking proprietary bets, is there a modification or a change to the Volcker rule that might allow for, if in fact there is a decline in liquidity in stressed corporate bond markets, that would sort of fix that problem if it exists?
Thanks for the question. As discussed in a little more detail in my written testimony, I don't think there's a lot of evidence, and you hinted at this as well, that there's been a broad-based deterioration in liquidity. So it's a little bit, you know, I'm not sure I fully agree with sort of the premise of that assertion, but there was one study that you alluded to done by Federal Reserve staff. I think it's notable in that respect that the periods of stress that study looked at were downgrades of the individual securities. So ordinarily when I think about liquidity in a period of stress, I think about market stress and market-wide stress, not an individual security experiencing a downgrade in an otherwise a normal market. So I think it's a bit of apples and oranges, that study alone, and I think read in conjunction with the rest of the evidence on liquidity, makes it difficult to conclude that there's been a broad effect on liquidity. That said, I heard Chair Yellen's testimony, I think it was yesterday on the Senate side, where she suggested trying to look at some of the complexity involved in Volcker rule implementation, and I think it's appropriate for the regulators to do so.
Can I get maybe, I don't know, SIFMA or T. Rowe, a private sector take on that question?
Well, just maybe add our perspective, which is we do think the Volcker rule, among other rules, is impacting liquidity. I think it's important to acknowledge.
Do you point to, sorry, let me just stop you, Mr. Strick. We talked about the Federal Reserve study. Can you point us to other studies that back that assertion?
Well, look, I think, and I think the Federal Reserve study, I think that is a good way to isolate what we would consider like a stress environment. And there are different ways to do it, but I think that was a really a thoughtful way of doing it. When we look at the volume of secondary market trading in the marketplace versus the total outstanding, it hasn't kept pace with the growth in the market. So we acknowledge, I think, that the primary markets are very strong. But there is a virtuous circle that exists between primary and secondary markets, and people will pay the better prices. They'll pay a liquidity premium when they have confidence in that very strong secondary market. They'll pay a better price in the primary market. So that's why liquidity is important. We're in a relatively benign environment where we have low rates, we have low volatility, we've had a lot of stability. We are concerned that if we had more volatility or a rising rate environment, that would put pressure on the market making. And to your point earlier on the small cap companies, there is evidence that despite the growth in the markets, that has been principally larger companies issuing larger bonds, and there's evidence that the number of smaller companies issuing, measured by size of balance sheet assets, has actually been in decline despite the growth of the marketplace.
Yeah, no, I take that point. Again, I've looked pretty hard at all of the capital markets, and again, I'll direct this to the chairman. It does, I think there would be bipartisan support for a hard look at capital availability for smaller businesses, but I'm out of time, so I appreciate the perspective and yield back.
Thank you.
Gentleman's time has expired. The chair recognizes the gentleman from Arkansas, Mr. Hill, for 5 minutes.
I thank the chairman. Appreciate the opportunity to talk about fixed income structure. Listening to this is always inspirational to me to see this much talent in a panel. We're all benefited by that. I have to tell you, though, that when I started in my financial career, the top technological innovation, Mr. Andreessen, was Munifax coming across the thermal paper in our offices in the 1970s. So it's been neat to see the evolution of the market from that moment where we did official circular files and kept copious notes to Bloomberg's advances, and now your trading platform you talked about today. You would agree, though, that there are houses that there are no bids for, and you would agree that have you ever seen you're a fencer, so is there an electronic scoring system in fencing?
Yes, sir, there is.
And how does that compare to human scoring? Pretty good?
Well, as an American, when I used to compete in Europe, we always felt like we got some inventive interpretations from the European referees about how to interpret an electronic scorebox.
Yeah, so, this is, there's no more over-the-counter, more complex market than the muni market, and you illustrated that.
I would agree with that.
And I listened to your opening comments, and I took them sort of as, I want to lead us to the future technologically, but I took your comments as a bit of a pejorative maybe towards dealers across the country that are in the muni market. You probably didn't intend that. Maybe you did. It came across pretty negatively. And, I think there's a lot of people out there trying to fill demand in the municipal market, which is very challenging, whether you're at T. Rowe trying to fill out a laddered portfolio or individual market making, which doesn't make me not interested in Emma's success or your trading platform. I'm for it. I just want to recognize that with over 1 million issues, some $1 million, some had one buyer, and the difficulty and the fact that most of them are non-rated, and even Bloomberg's database is feeble. That it's not fair to say, in my view, that this is just going to be eminently electronic, made electronic, and easily auctioned across the country. So I just want to, after 40 years of experience in the market, want to heave that off my chest. I feel better now. Mr. Chairman, thank you so much.
We are here for your therapy.
Thank you, thank you. And in Congress, we need it. We only have one psychiatrist in Congress, Tim Murphy from Pennsylvania. We need dozens more, so thank you for that. Mr. Crane, I wanted to talk a minute about the Treasury market, though. In your view of, you talked about the electronics there. Tell me a little bit about the changes in the market you saw at Treasury. We had 40 dealers when I worked at Treasury. We have 20 or so now. That's maybe not even relevant anymore vis-a-vis how the market has changed. Talk to me about access to the market, price discovery in the market, and just give me some more of your views on that.
Sure, thank you for the question. As you know, the number of primary dealers has declined over the last several decades. I think we're 23. At this point, I think in terms of secondary market trading, it is somewhat less relevant. The inter-dealer market was opened up to non-bank dealers beginning in the earlier mid-2000s. Firms like Citadel, eventually Virtu, are competing actively in that market, and it has really become their sort of two primary platforms, one operated by NASDAQ and the other is BrokerTec. And they operate a lot like our stock markets do. There's central limit order books, anonymous trading, high-speed electronic trading. And then there's a very different market in the customer market for a lot of good reasons. I mean, customers who, as I indicated before, may not want to expose their trade to everybody, may want to transact in a different market. But the dealer to client market is very different. Parts of it are electronified, but in many ways it's just sort of doing electronically what used to be done by the phone. The latest data I saw indicated that a majority of trading in the dealer to client space was still actually done over the phone, which makes, you know, think about the underlying nature of Treasury securities, you know, very liquid, very standardized, et cetera. So it's a little surprising to see that much trading by phone. But it is important to recognize that, you know, not all Treasuries come in the same form. You know, even on the runs, the most recently issued Treasuries trade a lot more, and then there tends to be a process, and I think this is true across fixed income, although the other panelists should validate this, that in fixed income, securities get issued and they trade for a little while, and then they tend to sort of find a home with a buyer, and then they trade less often. So you do tend to have these very different liquidity characteristics in more recently issued securities than more aged securities.
Thank you, Mr. Crane. Thank you, Mr. Chairman.
Gentleman's time has expired. In absence of members on the other side, we will continue on our side of the aisle. With that, gentleman from West Virginia, Mr. Mooney, has 5 minutes.
Thank you, Mr. Chairman. I'm very intrigued with the transparency comments that were made. I mean, there's a famous statement, Louis Brandeis in 1913, that sunlight is said to be the best of disinfectants. So, Mr. Sedgwick, so you talked a lot about transparency in your comments. Are you suggesting that transparency can do a better job than more regulations would?
I think in many respects, when you look at transparency, what that really does is help remove some of the obstacles to things, for example, like greater electronification. We tend to see more electronic markets in more transparent markets. So I think when I think about transparency, that's an opportunity to facilitate greater electronification. In addition, I think that transparency also, as I mentioned earlier, helps us manage our trading costs and be able to provide additional transparency back to retail investors. So I think that that's also helpful. I think ultimately, when we look at transparency, it's really about giving the market an opportunity to find equilibrium around things like the optimal state of liquidity.
Well, and so this question probably more directed to Mr. Shea as a follow-up. And we have here an ethics committee where there's 3 Republicans, 3 Democrats. We peer review ourselves to keep ourselves straightforward and review it that way. My wife's a doctor. They have other doctors that peer review what doctors do to decide if they've done something they shouldn't have done, rather than a bunch of bureaucrats. So, Mr. Shea, you mentioned a lot about surveillance, and I was wondering, can you do that? And then bad actors, keeping the bad actors out. Can you do that internally with some peer reviews of people in the industry rather than a government program of some kind?
We actually do that. So you're going to take on a new client, whether it be a PTG or a firm that meets our standards for joining our platform, and then you're going to subject them to a clearing sort of pathway. So they cannot gain access to our platform unless they have enough capital to satisfy the minimum clearing requirements, because we as an ATS in the U.S. Treasury space are requiring firms to eventually get their trades cleared through the FICC, which is part of the DTCC. So this whole shining of the light on one's balance sheet, availability of capital, actual firm capital is all measured and predetermined before trade one is even remotely put on.
Thank you. Mr. Chairman, I know time is tight and a lot of people in the queue, so I'll go ahead and yield back the balance of my time.
The gentleman is deeply appreciated by that, I'm sure, especially by the next gentleman. With that, we have Mr. Budd, who is up for 5 minutes or less.
Yeah, thank you, Mr. Chairman, and thank you, each of you, for being here today. So, to Mr. Sedgwick, post-Dodd-Frank and Basel III, we've heard from market participants that regulations that micromanage trading behavior is impacting liquidity. Specifically, a decrease in the lack of sustainable liquidity in U.S. swaps market, corporate bond markets, and the U.S. Treasury market. Do you agree with that statement?
I would say that the Volcker Rule, Basel III, Dodd-Frank were all factors in effectively disincentivizing dealers to commit capital to secondary trading. So what we've seen when we actually transact in the market is that whereas we used to transact with a principal commitment to do large trades, now much of the trading is taking place in a more agency fashion. What that means is that we're largely dependent on there being the opposite side of the trade or counter interest in the market for the trades we would like to do. The impact to us has been, in a lot of respects, to take large orders, split them into smaller sizes, potentially fragment our workflow, and source liquidity from different areas. So I think, in some respects, I'm sure you've heard a lot of conversation in the industry about low liquidity. In some respects, the real conversation is actually about the changing way in which liquidity is being accessed and how it's being delivered to us. That's been the most fundamental change since the crisis.
So in the simple yes, no, it would be a yes?
Yes.
Okay. We know that the U.S. fixed income market is massive at a roughly $40 trillion amount, and that the largest subcategory of that is U.S. Treasury debt. So with the national debt approaching $20 trillion, do you think that U.S. debt is not subject to market forces?
I would say it is. Yeah.
Okay. Well, in the interest of time, I'm going to let some of my colleagues go on as well. I have many more questions. If we come back after votes, perhaps I'll ask some more. Mr. Chairman.
Well, I appreciate that, and we have a number of gentlemen and scholars, apparently, on the committee. So with that, recognize gentleman from Indiana, Mr. Hollingsworth, for up to 5 minutes.
Good morning. Thanks to everybody for being here. I wanted to touch on, frankly, what Mr. Budd had started, which is, again, talking about liquidity. And I think, as the gentleman across the aisle had well said, perhaps some of the indicators show that there's ample liquidity in certain markets today, but I find out that it's not in times, in good times that you find out you have enough liquidity. It's really in moments of acute stress whether you determine whether you have enough liquidity in the market or not. And I was struck by the recent Treasury report that came out and some of its simplification and repurposing of the Volcker Rule, if not eliminating it, and was curious if you guys had a view on whether that went far enough. Some of the proposals that are out there in the Treasury report include eliminating the 60-day rebuttal presumption, changing some of the purpose test around prop trading, and then in addition to that, giving some more flexibility in determining what reasonable market making is for banks. And just curious if you guys had a view whether that went far enough in reforming Volcker Rule or whether we needed to go even further, in fact, in eliminating the Volcker Rule in order to enhance liquidity. And I would point out to my gentleman across the aisle that inventory is down 92%, according to Bank of America and SIFMA, but it's down a further 55% from 2013. So this is not just from a peak that is anomalous, but instead from even normal periods going back to 2001, we see that inventory is down dramatically, and I worry about liquidity.
I mean, our large banks are very well capitalized, as I've already mentioned. They've got huge client distribution networks. They were viewed by the market and the world as these wonderful risk transfer agents. So in that new ecosystem that the banks have created for themselves post-crisis, I think it would be very beneficial to have the chains taken off and allowing the banks to again perform their duties as risk transfer agents, and certainly in the yield or coupon security businesses that we're trading in.
Any comments from any others? Fair enough. The other report that I wanted to talk about was in the Federal Reserve's July 7, 2017 Monetary Policy Report. We recently had Chairwoman Yellen in. They describe, and I'm just going to read this statement and kind of interested in your views on it, a series of changes, including regulatory reforms since the global financial crisis, have likely altered financial institutions' incentives to provide liquidity, raising concerns about decreased liquidity in these markets, especially during periods of market stress, something I also believe in. But curious if that's something that everybody here believes in. And then, are there other regulations outside of Volcker that have contributed significantly to the decline in liquidity? Yeah.
Sure. So just to round out the point on Volcker, I think, and our members believe that, the Treasury report provided a lot of good suggestions. It may be best to repeal it if that's not the approach. A more clear definition of what is proprietary trading as opposed to the negative presumption, the 60-day test, and then the activities-based exemptions could be a better way to go. So we do think that's a rule that is impacting liquidity. People and our members that have market-making functions are doing so in a very cautious and deliberate way to make sure they're within the guardrails of what the rule would and the compliance regimes dictate. And things like Rent D, reasonably expected near-term demand, defining that is very difficult because it's a backward-looking process, right. And it often can be the case that as you look forward, the customer demand and the customer needs are quite varied. It could be, a large portfolio rebalancing that an asset manager wants to shift from fixed income to equities. It might be something where, a large corporation wants to enter into an interest rate hedging program to finance long-term debt that may be foreseen down the road and need to use interest rate swaps to do so.
I think that's right. And I think one of the things I hear from businesses all the way across the district, not just in the financial space, but all of them, is the gray area around regulators' ability to interpret rules is causing them to move further and further away from what they think the actual rule says because they just don't know how they're going to be interpreted, and there's so much gray area around that. So we get further and further back, thus hampering their ability to make markets or, in other businesses' case, produce the goods that they once thought that they could. And so I appreciate that.
Thank you.
So,
thank you.
With that, I yield back, Mr. Chairman.
We had been on a roll, and appreciate the gentleman yielding back. With that, we will recognize Mr. Messer for up to 5 minutes. I will make a quick note. They are debating the final amendment, and at this point, we've got 3 members in the queue, and hopefully we'll be able to get through that before we need to break for our vote. So with that, Mr. Messer.
Well, Mr. Chairman, I will work to not use my entire 5 minutes. I heard your message, and we'll work to do that.
10 points to Gryffindor.
Yeah. Great to follow my colleague from Indiana. Mr. Snook, I'd like to ask you I think fairly narrow, but at least to me important question. As you know, current regulations do not permit banks to hold investment-grade municipal bonds, American investment-grade municipal bonds, as high-quality liquid assets for the purposes of their liquidity coverage ratio, LCR. Creates this sort of odd circumstance under Basel where certain German municipal bonds can be counted as highly qualified liquid assets, where American municipal bonds, some of the best investments in the world, safest places to put dollars, are not. In a final rule released by the Fed in April of 2016, I was encouraged to see that the Fed conceded that investment-grade municipal bonds are appropriate for banks to hold under the LCR. And the Treasury Department issued a report last month that recommended these bonds be reclassified as 2B HQLAs. However, until the FDIC and the OCC act, banks will not be able to count these bonds as part of the LCR. So what impact do you think reclassifying investment-grade municipal bonds would have for cities and towns that issue bonds across the country?
Well, first, thank you for that question. I think obviously the municipal bond market is an incredibly important part of our fixed income markets. $400 billion in each year in and out, plus or minus, is issued in that marketplace, and it's obviously critical part of financing our infrastructure. We talked earlier about the municipal market being less liquid, and anything that further constrains or curtails the buyer base is potentially harmful. And so it's important that munis are treated as high-quality liquid assets for purposes of the liquidity coverage ratio, because depository institutions and banks hold over $500 billion in municipal securities. So for that to be constrained or curtailed, we think would be a negative. We think we want to encourage the use of munis, and if they're investment grade, high quality, readily marketable, that makes sense to us. Thank you.
Yeah, so on the margins, if them not being counted drives up the cost on the margins.
On the margin, will drive up the cost and put an additional burden on municipalities and taxpayers there.
And so the reverse, if they are counted, right, lowers the cost, less burden. So do you think this type of action would ultimately save taxpayer money while ensuring the integrity? You just said that, of course, you do believe that. So I guess my next question would be this: do you think legislation is necessary to ensure that investment-grade munis are reclassified as HQLA?
It may be the case. You know, we're hopeful that the banking regulators collectively work together to get there, but it may be the case that we in fact need legislation.
Yeah. Well, given in respect to the chairman's time, I guess I'll yield back my time. We're working on legislation in a bipartisan way to do that, trying to create a floor at that 2B level that would then allow them to be maybe lifted even beyond that. I mean, these are safe assets. They're rarely traded because, frankly, people take their money and keep it there. But in times of financial crisis, they're a place where dollars will flock, and so in that way, I think they're very liquid.
You know, and we're very much appreciative of the leadership and the work you're doing there. Thank you.
Thanks.
I appreciate the gentleman taking the hint from the Jumbotron behind there. And we have two. Hopefully, if we can get through that, that would be a great cap to this. So with that, Mr. Emmer from Minnesota.
Thank you, Mr. Chair, and thanks to the panel. You know, I don't have the background of some of these people, like my colleague from Arkansas, the 40 years that he's got. I just watch what happens and look at this market. And whether it's the equity markets or the fixed income market, available and accessible capital is what drives our economy. In many ways, in my opinion, these markets are the true definition of American freedom, the ability of people from all walks of life to access capital, to start a new business, to make an important purchase, to pursue their American dream. That's what these markets are all about. And it's interesting because we're talking about transparency and liquidity, the evolution of the fixed income market, the marketplace itself. And one of my colleagues was talking earlier to you about his concern with small cap companies, and I would add mid-size or mid-cap companies, because it seems what I've watched in the last 8, 10 years, maybe longer, but certainly as I've seen it more focused in the recent past, we have built policies, or we've instituted policies in this country that have allowed the larger to get even larger. They've been one-sided. I heard Mr. Shea talk about the large banks, and we should take the chains off and return them to their function of risk transfer function. And it seems to me, and my colleague from Indiana, Mr. Hollingsworth, actually cited the July 7th, 2017 monetary policy report from the Fed, and he read you a quote, which I hope you remember it, but I would like to know if you agree with that, and specifically the Fed's assessment of the state of the liquidity in the corporate bond market. And then I'd like you to talk, and it can be anybody on the panel, I want to know what regulations have contributed to the decline in liquidity and what are the potential solutions. And again, with a focus towards how do we get the lower end, the small cap companies, the mid-sized companies, so everybody has access to capital. Why don't you go ahead and Mr. Andreessen and start.
Thank you. So I serve on the Equity Market Structure Advisory Committee, and this was a focus from the beginning of that committee's work. We all agreed that the structure did a fantastic job for helping transactions be effectuated in spiders and Google and Apple and these huge companies, but clearly in the smaller cap names, that's a dealer-driven market. We're a dealer. Our purpose in the muni markets is to transfer that risk. We hold on each position on average about a month. And that is the same type of structure you see in small cap companies. You need some intermediary to step up and warehouse that risk between the investor that wants to buy and the investor that wants to sell, but they're unlikely to have those desires contemporaneously. So there's a bunch of pilot programs that are being enacted now on the equity side to try to help with that. I think on the fixed income side, you see an enormous profusion of new networks, new market platforms attempting to facilitate trading between buyers and sellers to try to fill this gap, but without a very diverse set of dealers to be able to do that, you're not going to be successful.
And I guess I'll go to Mr. Shea with whatever time you want to use, but I'm interested. Go to your example. We should take the chains off. I'm interested to know what regulation, what policy has been instituted on the government side that has encouraged, that we could perhaps roll back or modify, that has encouraged this getting bigger and bigger and squeezing out. I appreciate you're trying to find a way under the current environment to re-stimulate the smaller companies and access to capital, but what have we done that has caused this problem in the first place, and can we reverse it?
Well, just from the sheer size of the major players, and I'm talking about in the highly liquid, highly transparent, visible markets that we were all impacted by during the financial crisis. You know, you had mergers of these large institutions, you had emergency weddings, you had banks then being sued for everything from foreign exchange issues, ISDA fixing issues, LIBOR. I mean, it was one compliance and issue after another. So the banks, if you're sitting on a trading desk, and to my point about banks have traditionally acted as these risk transfer agents with large pools of clients, which as a regulator looking at these institutions you want, because you're going to have clients that are naturally offsetting risk within the bank's portfolio. What caused the market to go the wrong way was a result of risk and leveraged risk.
I think you and I are going to have to continue, and the whole panel, I'll be in touch to continue this discussion in light of our time.
Gentleman's time has expired with that. Last but not least, the gentleman from Maine, Mr. Poliquin.
Mr. Chairman, you always save Maine for the last, but that's okay. We don't take it the wrong way. It's still the greatest state in America. I appreciate everyone being here. I really do. Government should be in the business of helping our families. Helping our families. So if you are poor or disadvantaged, or you're disabled, or you're a veteran, or you're a senior that's trying to save for your retirement years, or you're a taxpayer, government should help you. And the decisions that we make here today set policies that make it easier for people like you to help our families in the private sector or not. Now, I was a state treasurer up in Maine for a period of time, and part of the fixed income market that I dealt with was the municipal bond market. And I'll tell you, yes, our companies, as Mr. Emmer said and Mr. French said, very important. They can access capital to expand their businesses and grow, pay their workers more, and hire more workers, because a good job solves a lot of problems. Also, in the municipal bond market, we need to make sure we continue to give our states and cities and towns across America a very low-cost way to borrow money. So it's critically important that you folks continue to make sure we have liquidity in that market, so we can drive down the price if you're a buyer, or increase it if you're a seller, and make sure interest rates are as low as humanly possible, because the taxpayers that are paying the interest every 6 months and repayment of principal at the end of the period. Now, there are some folks in this town, not me, that are floating an idea of taxing municipal bonds. Taxing municipal bonds. So all of a sudden, we have this additional burden, additional cost on the taxpayer to build a new sewage treatment plant in Ellsworth, Maine, or to build a new water treatment facility in Lewiston, Maine. And I'd like to ask you, Mr. Sedgwick, you work for one of the biggest mutual fund houses in the country, and you have, I'm sure, a significant municipal bond portfolio. Tell me what taxation of municipal bonds would do to the infrastructure needs of this country, and what it would do to the folks that are saving for their retirement that you service.
So I think it's actually a very complex issue. So as we look at the tax treatment, for example, with munis, but also with corporate credit, it's actually a very difficult sort of
I've got 2
discussion.
minutes and 4 minutes and 13 seconds before I have to vote, so you have to make it very complex, make it very simple quickly.
I'm sorry, I'm not a muni trader, but I can certainly circle back with you and get you a written response
Great.
on that.
Mr. Snook, do you have a comment on this?
Yeah, I think, you know, we have tremendous infrastructure needs in this country. The municipal tax-exempt market is an extremely well-functioning market. We talked about the fact that there are almost 1 million separate securities outstanding. That reflects our ability and the market's ability to serve all those issuers well, those small towns, those municipalities, all those different local entities. And if we take that tax exemption away, will undermine that market greatly. Because when we talk about liquidity and the ability to sell small size, it'll be devastating. Because right now, we've had a very strong amount of demand from the individual investor directly and indirectly through mutual funds. If we were to take that away, we throw a tremendous cost burden back on those local cities, states, and municipalities.
Thank you, Mr. Snook. Mr. Shea, you have last say. I've got 1 minute.
Again, I'm not a municipal bond trader either, but I think adding friction to any market is not going to be good for the individuals or the municipalities trying to raise.
Thank you all very much for being here. Really appreciate it. Mr. Chairman, you have back my time.
Gentleman yields back. And with that, I want to say thank you to our panel. Already we've gotten comments from members that this was extremely illuminating, very helpful. And as I was starting to say in my questioning, we're really looking for some industry consensus. I don't know what exactly that means and what we're going to be able to get to, but I deeply appreciate this input and your time and effort being here. I look forward to working with Chairman Clayton as well at the SEC to see where we can go and work hand in hand with them where we are able to. Without objection, all members will have 5 legislative days in which to submit additional written questions for the witnesses to the chair, and I will then forward those questions to you all for a response. And please, I ask the witnesses to respond as promptly as you are able to. And then also, without objection, all members will have 5 legislative days within which to submit extraneous materials for inclusion in the record. And again, thank you for your time, and this hearing is adjourned.
Thank you.